Hey everybody, it's Chris with Life 180, and I am here with Galen Nuttall from Canadian Whiteboard Finance. And back to our weekly videos. This is my first video after being in Costa Rica for a couple weeks. And so, Galen, thanks for being here, man.
Yeah, no, thank you for choosing me as the first one back to reality after the amazing Costa Rica trip.
Yeah, man, it was a lot of fun. So today, we were just talking, and you were talking about some IFA stuff. Is that what it's called?
Yeah, up here at least it's immediate financing arrangement, the IFA.
Okay.
For when people are looking at taking on a whole life policy.
Perfect. That's awesome. So in the United States, it doesn't really work this way. So this video is going to be really geared towards Canadians, which is awesome. And I think from what I've heard about this, and I've talked to you and a couple other people about it, I don't know all there is to know about it, or whatever, but it seems like a really intriguing opportunity. And I honestly, from what I've heard, I wish we had it in the United States. Like honestly, like every time I talk to a whole life person in Canada, like a whole life salesperson, I just think like you guys got it so much better up there. Like it's so much easier to sell whole life insurance in Canada because it's so much more like valuable, and it's amazing in the United States. And it's just like when you look at the tax laws, when you look at the way, the economic system works, when you look at all the different little nuances, like the IFA we're going to talk about, all these little things that you can do. It's like, how did Canada like somehow beat United States at this? Like, I don't know. Like, it just seems like it's so much better in Canada. So like I said, as good as it is in the United States, and I talk about it and I love it, for entrepreneurs and real estate investors and all these different types of people in the United States. And I think it's like absolutely a core foundational asset that everybody should have. You take that and 5X it for Canada. And that's how much more important it is, to have this as a foundational asset in your life as a business owner, as an entrepreneur, as a real estate investor, as like almost honestly anybody in Canada. It reaches everybody. And so I'm super excited to kind of talk to you about this and learn a little bit more. So can you, I guess just to start, can you kind of like do the 101 overview of what an IFA is?
Sure. Yeah. And I mean, you're talking about Canada versus the States. I mean, maybe it's just like, maple syrup, curling, and hockey. Like maybe it's just
whoa. First of all, that's fighting words. I'm from Vermont. You're not
okay. All right.
Canada has better maple syrup than Vermont.
You got the maple syrup there in Vermont. You got the maple syrup.
Yeah. I will guard that with my life. The hill I'm willing to die on.
Did you hear about like it was like hundreds of thousands of gallons of maple syrup that were stolen up here last year? It was like this big news story in Quebec.
That's like breaking news.
It's stolen like millions of dollars of maple syrup. That stuff's expensive, man.
Oh, totally. It's like,
but yeah, I didn't know until a couple of weeks ago that like the non-maple syrup up here, they just call it sugar syrup. Okay. Like kind of the stuff I grew up on. Like every once in a while we'd splurge on some like log cabin stuff or whatever. But most of the stuff we had,
log cabin is all fake.
Oh, was it log cabin? Or maybe I'm misremembering.
Like Mrs. Butterworth, Aunt Jemima.
Yeah, Mrs. Butterworth, they just call it sugar syrup up here.
Oh, really? Okay.
Yeah, because they're like sugar syrup. I just heard that the other day because I was camping with some friends and they're like, yeah, sugar syrup. I was like, that's really smart, like maple versus sugar. Yeah. Anyways, so yeah, what I'll say is, I mean, one of the big things that makes whole life more applicable, at least from our conversations in Canada, is just because our taxes are more extreme. Our estate taxes are more extreme, it seems to me. So that's one of the reasons why I think a lot of people, like as I've mentioned, like there's a doctor finance guy in the States who's really anti whole life. And when I look at the comments he makes about it not being a great idea, is partially from the estate planning perspective. And now I don't know exactly how it works down there, but I wrote him and I told him, like, up here in Canada, like you get to that 50% estate tax very fast in Canada. It's very easy to get there, which seems to me a little bit different than the States. And then we've also talked in the past about capital gains being, capital gains up here is instantly 50%. There's no graduated level. It's like instantly 50% is capital gains. So that's another thing. And the rumor is every year, that they're going to take it up. They haven't done it yet, but every year the rumor is they're going to take it up to like 75 or something. So whole life is, there's obviously some very specific good reasons for using it up here. A big part being around tax planning. Now the 101 on the IFA, so immediate financing arrangement, IFA, bit of an advanced concept. So I'm going to stay to like the high level today. Mm-hmm. I'm going to talk about like among whom is this really popular? and I'll just kind of talk about like, you know, who looks at doing these. Again, like when I do these, I have to like send these illustrations around to different like people to make sure that they work. So it's a pretty specific thing, but it's based like it's really popular among. So I mean, the concept around it is someone says, "Hey, I want to take on a whole life participating insurance policy. Is there a way that I could do this and not have to come up with the whole premium right off the bat?"
Okay.
And the way that the immediate financing arrangement is you look at what's the total premium, what's the cash value you're going to get as soon as you start putting money into it, and looking at can you use that cash value to immediately borrow against to keep the policy going rather than having to come up with the whole premium yourself. So really what it is like young professionals who are not necessarily interested in borrowing against their policies quickly and are using it for more of a long-term retirement strategy where they say, look, so doctors, I'll give the doctor example. So a doctor who's starting out, a lot of times they jump from residency to practice. They start making a lot more money, but maybe they've still got a lot of overhead. Maybe they're still building their practice. Maybe they're still figuring out some like the nuances of running the business of a practice. Or they've still got a lot of debt that they're paying off, or like their lifestyle is just starting to ramp up. So they're like, you know what? I don't have a ton of cash now, but I know like 10, 15 years from now, I'm going to have way more. Like my kids are going to be grown up. My house is going to be paid off. You know, my practice is going to be chugging along. So they look at the long-term need and they say, you know, I really should take on a policy like, you know, of this much per year, but I can't afford it right now. What can I do? And so basically what you do is you borrow to pay the difference between the cash value and the premium. So a lot of people, what they can look at is taking on a larger premium earlier on because they don't have to come up with the whole premium right away.
So I wonder, is that like premium finance in the United States? It sounds very similar.
I think that might be it. I remember someone telling me, like kind of mentioning what in the States is similar, and it sounds like it might be. Is it work like your I mean, how does it work in the States?
Yeah, I mean it's very similar to what you say, and there's honestly there's no simple way to explain premium finance in the United States. There's different ways you can leverage it based on the different type of product. A lot of people are actually using IUL right now, which I think is a super dangerous thing to do for premium finance. It's been done with whole life for a long time, but like it's all about leverage, right? It's about using bank money to buy insurance and build cash value and creating arbitrage essentially in between the loan rates and the return.
Yeah, I mean, interesting that they're doing it. I mean, the company that I was literally on a webinar today with a company that was kind of going through some of the finer points of this, and I don't think they'll even do it for UL, like the one that was talking today. Maybe there are some that would, but some banks up here don't even touch universul life for loans. They just do. Do participating.
That's pretty common. I mean, down here we have the cash value line of credit, which banks will do for whole life, but they won't do for IUL. And that speaks a lot, you know, to what I always tell people, like IULs are not all they're cracked up to be. And if the growth in IULs was so, predictable and good and consistent and, dependable, first of all, insurance companies would be using the strategy that they use for IULs with their whole general fund to be able to get better returns in a really stagnant market, you know, and these banks would lend and leverage them and let you leverage them better. And they don't. And listen, if you think you know more than a bank knows, well, I got another thing for you. So. Anyway.
Oh yeah, I mean, certainly some of the people that have reached out to me from the videos have said to me, "Oh yeah, I've already got a UL policy," or, you know, "Should I take on a UL policy for this?" And, you know, I talk about how, I mean, one of the things is simply the philosophy I have is I don't mind people investing, and I see this as a part of what other things people may have going on, like real estate or a business or, you know, whatever. Really, participating whole life plays a very specific role in that. And from what I've seen, universal life does not replace that at all. Because, and I mean, just like talking about from the borrowing standpoint, the companies that do offer financing for UL, I'm pretty sure they only give up to 50% usually. Whereas up here with participating whole life, they loan up to 90%.
Yeah.
They do 50 with UL because they know it's the guarantees just aren't the same. Like they're not willing to put themselves on the line for something that doesn't have the same level of guarantees around it.
Yep, I love it. Down here, they'll do 95% of the cash value in a whole life policy that they'll lend you for a cash value line of credit, which is pretty
for 95 for whole life. And what about for UL?
Nothing. They won't let you do it.
Yeah. So that's one of the big things I've talked about. Some of the people that have reached out to me from the videos. So this one, like I said, like I am still looking at ways to whiteboard the IFA and to make it simple for people. Really, the cool thing about when I run the illustrations is it basically shows the net benefit down the line of having done this, and it's pretty cool. Like it just shows like how the cash flow isn't as high out of pocket because you're paying for a portion of the premium plus interest on the loan that you're using to finance it. And you can technically just leave that loan forever and let the death benefit take care of it like 40 years from now, which a lot of people do. They just leave that once that loan hits the top, they just leave it, they pay off the simple interest and they let the cash value and the death benefit just keep growing. And they're like, down the line, it'll take care of that. Like, like more than enough to take care of it, or they can pay it off. Like it's very flexible. You can either pay it off or you can just leave it until the end of the day. And I'm sure like a lot of people just like the idea of leaving it because they'd rather just have the cash freed up.
That's awesome. So talk to me, who is this good for? Who is the ideal person who you think this is like a good fit for?
Yeah. So what I'd say is it's a good fit for someone who's looking at doing 50,000 or more in premium a year, because that's usually the minimum threshold to get qualified for this. The lenders who are lending financing to people are looking at 50,000 a year for 10 years. So it's good for someone who, like I said, like a lot of the professionals I know that this is a good strategy are very interested in putting money in for years and years and then using it to supplement retirement as a borrowing strategy. Different than the people who come to me and they say, Galen, I want to put premiums in for 10 years or less, and they could still do it technically, but the premium would have to go way up because they're looking at a total of 500,000 of loan. So it's really good for someone who's in it for the long haul, 10 plus years. Like I said, it's a good fit for professionals who have maybe lower income now than they're going to have in the future, but they still have a need for retirement planning, for insurance coverage, for tax efficient growth. Like they're looking for all those things. And they just say, you know what, I can't necessarily come up with all the money out of pocket today for all this, or I don't want to tie up all my money, all the money in the premium. Then they only have to tie up a fraction of it and still be able to take on the same policy, just that it has like an inherent loan from day one.
That's awesome. That's cool. So are there any drawbacks to it that you would, aside from the fact that you need 50K a year, you're really talking about, a certain demographic of people, but
yeah, for sure. Like it's definitely, like I said, like a lot of the people I see doing premiums in that neighborhood or higher are doctors, professionals. If you have a corporation, obviously it's an even better deal. So I'd say that the drawbacks would be that people who are doing this are not looking at doing a really quick deposits. Like that's not the demographic. Or if someone's looking to borrow quickly against their policy, because I do meet people who say, hey, I'm going to put this money in, how quickly can I turn around and borrow it? That's not going to work because that cash value is technically still part of the loan in the early years. So you can't take it and use it in two places at once. Like you can't borrow against it to use it to keep the policy and borrow against it to go put it somewhere else. So it is for more of the long-term folks, which is a lot of the people I started out with years ago when I started as an advisor were people who were committing to at least 10 years, if not 20 plus. Like if I've got a doctor who's in their 30s, they're looking at easily in the neighborhood of 25, 30 years of premiums, such that by the time they go to retire, they can just borrow a ton of money out of their corporation.
Yeah. Got it. That's awesome. So what else would we need to know? It seems super straightforward, and it seems like if you are a doctor, if you're a business owner, entrepreneur, and you need to kind of come up with your own retirement strategy, this is a play that would definitely make a lot of sense because it's getting $1 to do multiple things for you, which is fantastic. For your personal life, for your retirement, for your business, for your legacy, for your, estate and tax planning, all that stuff. Right. So, it seems like, that it's just a no-brainer for people. So what would you say is the next thing for people to do? Like, or like, you know, for people who are interested in it, who want to learn more, are there resources? You know, could they call you and have a conversation with you about it? Like, what would you suggest to people?
Yeah, for sure. I mean, the biggest thing, yeah, I mean, you definitely want to be talking to someone who knows how to look at all the different options,
Yeah.
because this is just one of them. Like, really, I don't bring this option to the table until I've got a really good feel for what someone's up to around this.
Yeah.
So,
Yeah.
you know, I had a business owner out in BC reach out to me, and he was like, "Yeah, Galen, I want to build the cash value really quickly. I want to borrow against it, you know, quickly." And so I'm like, "All right, doesn't sound like this is going to work for you." Then more recently, I had a doctor reach out to me in Ontario who said, you know, all my colleagues are doing whole life inside of their corporations. I'm really interested in this much of a premium. Is there any, and for a long time, she's like, I don't want to access this in the short time. I definitely want it just to keep staying. Like, she's like, not planning on it. She could, like, technically, like in general with whole life, she's not planning on it. So she's like, Galen, this is a long-term retirement strategy. Is there something you could do to make it look even more attractive? And so that's when I start running the immediate finance arrangement options. Because before that, people might get excited about it, like, oh yeah, like, I mean, because it can mistakenly sound like they're getting like free life insurance or like really cheap life insurance, but that would not be accurate, because it does something has to shift. In this case, it's your access to the cash value in the early years is limited. So I mean, really, definitely, people, you can reach out to me as always. You've got the link there in the comment or in the description. Really starting with the general idea of when people come to me, it's like, you know, they usually come to me with an idea of how much money they've got, how long they're going to put it in for, and the final purpose of it all. And then I can take the time to say, okay, either you fall into this category where an IFA could make sense, or you fall into the category where I can tell right off the bat it doesn't make sense. And then if it does make sense, I simply just show the you know, I've got graphs and charts and stuff that just show the difference between not doing it and doing it, and what the net benefit will be at the end of the day.
Cool. And at the end of the day, it doesn't hurt to take a look and see what it would look like for you, right? No harm, no foul in checking it out. I'm a big believer with this stuff to leave no stone unturned, right? It's a big part of the education process, you know, in personal finance, is like really taking a look at some of these alternative strategies and methodologies and seeing what they would look like, you know, and that's, I think one of the things I like about it is you could kind of get some clarity about what it would be like for you on a guaranteed basis with no commitment, no nothing, just to kind of see. And then if it makes sense, you can move the ball forward and you know, talk about potentially implementing it or whatever at that point in time. So that's awesome, man. Is there anything else?
No, that's it. I mean, I really like what you said, leaving no stone unturned. I mean, I think that definitely in the early days when all I had was like the easy sort of training around how these things worked, it was definitely like, it's very easy to fall into a prescriptive method of everyone has to do this the exact same way. When in fact, there's the last video we did was about how flexible whole life can be. I'd say that most people, when they come to the table, they don't understand how flexible it can be around. And we talked about how even me just flipping the switch on my software makes it more flexible. And then I can even send it up to have like a review from the actuaries to make it even more flexible.
Awesome.
Like it takes extra work on my part, but I want to make sure that at the end of the day, my clients have got the best option possible. So I'm willing to go through a few levels of analysis to be like, all right, I've run all the analysis. I'm confident that this is like your best option for what you want to accomplish. So yeah, no, that's it. Like, just knowing that there's that option out there could make sense. It's always good to check it out to see if it makes sense.
Rock and roll. All right, guys. Well, I hope you found value in this. If you did, would really appreciate a thumbs up, a like on this video. YouTube loves it when the more likes we get, the more people it reaches, obviously. So that's fantastic. And then if you haven't already, make sure you click the subscribe button, hit the bell. That way you get notified every single time we launch a new video. Galen and I try to do at least one video like this every single week. So if you are in Canada and you're seeing this, we're doing all sorts of great content, and we have done all sorts of great content on topics of this nature, you know, for personal finance in Canada that I think are really beneficial for people. And aside from that, obviously, if you have any questions, I try to engage, and I know Galen engages with the comments in these videos as well. Try to engage with every single one. So leave a comment, make a comment. If you have any questions about anything, ask it in the comment section. We will respond to every single one. So that's it for now. Until next video, have a blessed, inspirational day, and we'll talk to you soon. Take care.